Hey everyone, welcome to our latest webinar at M13. I am really proud to be able to boast such a wonderful panel on this particular webinar, where we're basically here from different places. We were just discussing that, and kind of all working from home during this period. But we've gathered a panel of experts around both early stage investment as well as from both the investment side as well as the operating side. And so with that being said, I'd love to just introduce the panelists quickly, introduce myself, and then maybe just jump into a conversation around the evolution of company's journey from seed to Series A. So just to start with myself, obviously we're M13's $185 million fund. We're built by founders and operators. And I think what we like to boast is this balance of operating capabilities. We have a whole operating partnership team that works very closely with our companies that we refer to as our propulsion team. I myself am an engineer by training, and I turned entrepreneur in the 90s. And so I've had 20 odd years building businesses. Most recently, I was COO of DigitalOcean for the last 5.5, 6 years before I joined M13. With that being said, I'd love to introduce the panelists. First, Brad Gillespie, that I had the honor of working with DigitalOcean. He was an investor at DigitalOcean, general partner at IA Ventures, I think for the last 11 or so years. Really fantastic investing record that they have, and just super excited to have him on board. Jenny Fielding, who is Managing Director of Techstars and also runs a fund called The Fund, which I think is a collection of founders, I believe 70 or 80 odd founders in New York, Los Angeles, and London, I believe, who kind of all dedicated to kind of paying it forward and finding entrepreneurs of the future in their local markets and helping them grow and develop and invest in them. And then Alexandra Wilkes-Wilson, who is a serial entrepreneur, incredible background, incredible list of achievements, but just to name a couple, founded Guilt, was founder and CEO of Glam Squad, and a number of other ventures in her back pocket. And so really excited to have her on board as well to kind of help us navigate from a founder's perspective what the journey looks like as you kind of go through your investing challenges. So what we're really here to do today is kind of talk about the state of the market today. I don't think we're going to talk specifically about the COVID as a specific issue, but rather, the cycles that the market naturally goes through, the investment community and the market naturally goes through. I've had the pleasure and the difficulties of dealing with both the 2000 bubble and the 2008 financial crisis. And obviously now we're going through another type of crisis. And I think what we've seen consistently over the last 20 years is just a cycle of bearish and bullish investment markets where investors have taken different positions and taken different levels of risk or consideration in their investment decisions. So I think what we're trying to address here is, what is the market going to look like over the next 2 to 3 years? How does it play out for you, the founders? How should you be thinking about the approach to market and the way to identify the right, perfect partners for yourselves as you move forward and grow your business through different stages of investment. So I wanted to kick off maybe just by clarifying, and I'd love to get, perspectives from the panel of something that has changed over the years, which is how all of these rounds are labeled, and kind of trying to define what seed is versus what Series A is, how we want to think about it for this conversation, and how that has maybe changed over the years. So maybe just to kick off, Alexandra, I'd love to ask you from a founder's perspective. All these fungible letters have been like super confusing over the years. From 10, 15 years ago when you were, starting off with Guilt. How have you seen kind of the evolution, and is there any logic from a founder's perspective, you think, around the way the world's changed, the way people think of these rounds of investment?
Well, I think in simple terms, rounds have gotten a lot bigger than they were back in 2007 when we started Guilt. So that's first and foremost. I would say that specific to COVID, I would really share with entrepreneurs, cash is king right now. So you really need to have your eye on your cash constantly, understand your burn. Are you being as prudent as possible, making sure you can bring your burn down? Because the reality is a lot of us don't know what the next months and even couple of years hold for us. So you really do want to be careful. I would say that my advice to some founders right now is to be careful of that more typical venture style, aggressive top line growth mentality. I think top line growth is incredibly important, but I do think that in this environment, a path to profitability is important, and is important even in earlier stages than it probably was before. So think about your path to profitability in light of post WeWork, COVID, and something I always say to founders is really think about the investors you want before you need them. So start building those relationships. If you're in the process of raising a seed round or a Series A, that doesn't mean you shouldn't be meeting people who could invest in your later rounds, because for a lot of investors, they actually do want to track you and your company's growth for a pretty substantial period of time. So build those relationships before you really need them.
Have you seen kind of a fluctuation in the expectations on a business at kind of different stages of funding? I'm assuming that that's changed significantly over the last 10, 15 years, maybe in a cycle of sorts.
I mean, I think what I saw years ago was very, very top line, grow, scale, land grab, get out there. And not to say that that's a bad thing to do necessarily, but I do think if you raise too much capital and subsequently might have to have a down round, if you spend too aggressively, these are all things that you really need to worry about, especially if we're going into a recession / potentially a depression. So, keep your eye on your cash.
Okay, fair enough. Good advice there. One thing that
about the round. So when I started my first company in 2006, a seed round was like $250,000, and you thought that was a seed round. So maybe up to 500. So I think that the terms and the expectations have really shifted over that period, substantially. Now your average seed in New York City is about $3 million.
And so that was, I remember when I was starting my early companies, that was like a full-fledged Series A. So what would you call a Series A today? Like, for the purpose of this conversation, if a $2-3 million round is a seed, where are we at Series A?
Yeah, it seems like in New York, 7 to 12 are what the Series A's that we're seeing. So that's like a big jump.
Mm-hmm. And one thing that actually has evolved a lot, I think, in the last number of years is the introduction of incubators and their role in preparing companies and getting them ready. And I know you're obviously, Jenny, Managing Director at Techstars, so it's really kind of a good digression to you on how you think that has come to play as a part of the journey, and maybe even beyond that, Brad, how does that play into your thoughts on sourcing and identifying potential businesses into the future? So maybe Jenny, first you can talk about kind of the role it plays.
Interestingly, I feel, in this day and age, the accelerator has become around in and of itself. So, people are like, oh yeah, I did friends and family, then I went through an accelerator, and then I raised, my pre-seed around that, and my seed. So it's kind of interesting how it's been now part of the language, but also just like such a part of the fabric of going through stages. And oftentimes I'll meet founders who really, are just starting out, and they'll say like, I want to go raise a seed, 3 to 4 million. And I think about all the steps before that many founders really go through. And so again, it's that kind of friends and family, that angel money, probably going through an accelerator, potentially, especially if you're a first-time founder. And then getting a pre-seed investor, which didn't even exist a number of years ago, a whole category of investors, including myself, that really focus on, being an institutional investor at that kind of first check level.
And that's where the fund focuses, correct? In that pre-seed.
Yeah, exactly.
The average check is how large for like that pre-seed activity?
Yeah, so we only write 100K checks, and really we came into the ecosystem because we saw, so many of the funds, especially in New York, had gone upstream into those seed rounds being 3 million, and we saw this gap. There was angels, but there wasn't a lot of institutional capital at that early stage. And so, one of the impetus for me was like companies were coming out of Techstars, like brilliant companies, and they were really struggling to raise those kind of, let's call it 750 to 1.5, and they were going to angels and collecting 25K checks, and that was taking them so long. Yeah. So, a bunch of founders kind of got together and were like, okay, if we could put 100K check in, like potentially we can be a signal to get some of these other folks off the sidelines, so the founders don't spend 6 months, raising $1 million, which is just like not a great use of their time.
Yeah, and it's interesting because I know, 5, 6, 7 years ago, your typical incubator, or maybe even longer than that, but a typical incubator would invest $10,000, $20,000 to support these companies, and now they're investing $100,000 to $200,000 as part of the incubator. So it is really truly becoming a kind of a pre-seed or early seed component of the business's funding story. So Brad, how do you kind of see that journey and how it begins to introduce into your category of investment?
Yeah, which I think we're sort of squarely in that $1 to $3 million seed round, and we've tended to think of accelerators, angels as getting, helping founders get a product into market. Doesn't have to be much, but at least get a demo or at least get a few early customers, some really interesting green shoots that then enables them to raise that kind of $3 million seed round. And like what we look for in that seed, that $3 million seed, ends up being, can you prove irrefutable product market fit? That's the kind of thing where you could take this demo or early product and get it to a place where you have a interesting set of customers who are all using the product for the same reason. And so that tends to be what we've looked for.
And how does, when you talk about your sourcing, like how much does the incubator model feed into your sourcing strategy? And are there other ways in which you find yourself, identifying great opportunities?
I mean, I'd say sourcing is probably the thing when we started out at IA that I didn't fully appreciate was how idiosyncratic sourcing would be, where it was in many ways looks a lot like angel investing, where it's relationship driven. It's also previous second-time founders, which is a luxury we've had by being in the business so long, but also incubators and sort of, as Mark Juster likes to say, connecting lines, not dots. And so it's being able to see through as founders progress across an incubator and after, seeing that progress. And that's something that really helps us get conviction.
Great. I just wanted to, I forgot to mention for everybody listening, now that we have kind of quorum at the in the audience, questions. We will get to some Q&A activity towards the end of the session. But in order to submit your questions, please submit them by pressing the Q&A button at the bottom of the screen. And we will sort through, and we may actually invite somebody into the video to ask a question live. So we're going to get through some conversation, and then towards the end, we're going to open up and have some Q&A with the panelists. So to your point, Brad, it's a good kind of evolution to the next major section that I want to really cover, which is, the qualification for a company as it gets to this true kind of series seed round, the multi-million-dollar, often the first institutional money that a company will really see. There are a number of different ways, you can really measure a company, whether it's a great founder track record. You talk about, second-time founders and track record that helps. It's the product market fit and market validation that you also talked about. There's also this concept of just raw potential and excitement about a group that you guys have an underlying feeling on. So I'd love to, love to get a better understanding for our founder audience. What are the kind of are there any standard expectations, standard things that you feel these companies need to demonstrate or show, maybe just one level deeper, that kind of gives you confidence or makes you start feeling like these guys are ready for consideration in kind of a more institutional round of funding? So Brad, this question for you.
Yeah, I mean, I think, to go a level deeper, right? It's like one of those things ultimately ends up, for us, we look at a bunch of the different things that you've sort of articulated, call it market tailwinds that are broadly there. That's something one would want to see. We look a lot for what I'll call customer domain expert. I think there are other investors who don't value that as much, but for us, we want someone who deeply understands the problem so they can go out and deliver against that. And then, when it comes to product market fit, it's one of these where it's a little bit, you have to be skeptical. If you have to ask if you have it, you don't. And I think it's different for every industry a little bit. So it's hard to generalize, but I think a rule of thumb that often gets thrown around is that, for SaaS businesses, getting north of that 100K MRR, seeing it growing rapidly, beginning to understand that's the sort of goal to get to for, out of a seed round. So coming into that, you want to believe that there are the green shoots that can lead someone to get there over 18 months.
And I would chime in on the consumer side. One thing you really want to be able to demonstrate is engagement. Do you have consumers who love your product or service and who are investing their own time and energy to give you feedback because they really want your business to exist, because it's, for whatever reason, solving a problem or meeting a need that they have, and they're some of your biggest advocates and supporters because they want you as a business to succeed.
So Cassandra, to that point, do you think that the world has changed in the level of expectations? I mean, obviously we're in a change moment right now, but we've been in a relatively bullish investment market for a while. 10 years ago it was probably a more bearish investment market. How do you think that's changed in terms of the access to capital or the expectations on the founders? Is it just a more extreme version of the same thing, or are there just different levels of expectation based upon the strength of the market?
Well, I think there's a lot of capital out there. And I think from the founder perspective, you should really be trying to get capital from the investors that are going to increase your chances of success. And so go for the smartest capital relevant to your business that you potentially have access to. And I know it's really hard to hear as a founder, oh, there's so much capital out there, because when you're kind of struggling to raise that money, it might not necessarily feel that way. But the reality is there is a lot of capital out there. And the more you can get out there and make relationships. And prior to COVID, I would have said it's really hard to build relationships over Zoom, but you know what? Everybody's doing it right now. We're all kind of getting used to this. And I think it is possible to fundraise in this new Zoom-like environment.
So, I would add that it's a little bit more art than science. I mean, people might say, okay, a SaaS company needs 200K MRR to raise their A. I mean, the truth is, I like to think of it as like a game of rock, paper, scissors, right? And so, great founder market fit, like that trumps like revenue, right? And so there's kind of like all these levels and layers. And you have to, as a founder, just kind of figure out what are your unique attributes. Are you a second-time founder? Is that going to give you street cred? Do you have like incredible metrics? Do you have, there are all these kinds of, it's like these unique combinations that you've got to sell to an investor. And an investor is going to resonate with different things. So, I wish there was more formulaic, but I find at the early stages, it's really not. As we go further upstream, I think it is.
Do you, Jenny, I mean, obviously you're heavily involved through Techstars or through the fund itself in helping companies try and graduate to that seed level of investment. Are you, are there strategies just in terms of the networking side or the relationship building side of, I think we've already discussed a couple of times of starting the process of meeting with investors early and creating a relationship. I know Brad is a true believer in building relationships with the investments he's going to be making well ahead of the time of investment. So, from where you sit and with the portfolio that you either look after in Techstars or the portfolio at the fund, how do you advise founders in terms of their navigation and that side of the coin where they're trying to identify, first of all, how to get in front of people, but then also maybe even how to identify who the right partners would be?
Yeah, it's a great question. I definitely see one of my primary roles is really connecting our founders with upstream capital. And so, it's kind of a constant matching of, really me understanding the ecosystem and helping to match founders. But I also tell founders, like, unfortunately, they want to just be running their business, but they have to become experts at, who's in the landscape and at venture capital to some extent. And to do that, like, I really, emphasize staying organized, creating a great investor pipeline doc, and really just like getting to understand the psyche of like, okay, well, what is Brad and what did those guys like to invest in, and what have they invested in, and really understanding their portfolio. So as founders, you kind of have to become the experts. And I know that that's not super appealing or comfortable for many founders, but I think it's like, it really helps with fundraising. And I often find when I get inbound, whether it's cold inbound or it's an intro, and it's a really well thought out, introduction. Someone's read a blog post that I've written about areas that I'm interested in. If they've done their research on me, I'm much more likely to lean in. So that's like another tip that I really give founders, is really try to understand and get to know the investors. Don't just think of it as this kind of transactional, like, I want money, I'm going to go pitch Brad, but really understand. What is Brad interested in? Like, what are some of the things he's writing about? What are some of the spaces that he cares about? And like, how can I relate to Brad more on a humanistic level?
Yeah, so Brad, an interesting question for you. I guess this is a little bit of a kind of behind the scenes hack that some people play with, is the idea of, looking for guidance and mentorship ahead of investment. So starting early and building relationships by speaking to potential investors like yourself about just getting help and support with the thinking process. Is that a real hack? Does that actually work? Do you find that you get engaged when you find people that are really interested in kind of pulling in your intellect into a discussion as much as your actual investment potential?
Yeah, I mean, I think we're all human, and so part of that is absolutely an important part of it. I think for me, it's like, look, I'm never going to be the expert on the business that the founder is. So ultimately, I can give pattern matching and sort of see areas that people have perhaps gone astray in the past, but like, I should not be running your business. So in that sense, I think of that role as more of a sounding board. And so the highest value for me in that engagement is actually seeing how you, the founder, are thinking and evolving the business over time. So the real hack is, it's a way to see, is this founder formidable? And are they ones who can figure it out, and see them in real time figuring it out?
Yeah. Great. So I'd love to transition a little further down the journey. And I think the biggest thing that I'd really want to try and kind of get under the skin of is, I think a lot of founders struggle with the idea of where they are in their journey. I know that a lot of companies in our portfolio are just always asking, hey, when are we going to be ready for that next round? What makes us ready? We've talked a lot about just the basic requirements of what is expected for that first institutional money, but maybe similar to the question I asked Jenny about how she worked with her portfolio, maybe Brad, you can elaborate within your portfolio. How do you navigate the concept of follow-on investment, and what actually, how do you work with founders that are not quite ready but think they might be, and then how do you actually identify when they should be ready? Love to get your thoughts on that so that people can navigate that challenge.
Sure. Well, I think the first important thing, which sort of loop back to a few minutes ago, is what Alexander was saying about cash is king. So the most important thing is not to be in a position where you have to raise when you're not ready. So a bunch of the value of preserving cash, and like when you're raising your seed, having 24 plus months of runway, is to really figure out a lot of things. And depending what do those things look like, I mean, it's sort of industry dependent. We've talked about engagement. There's revenue. There's, as in DigitalOcean's case, off the charts NPS, that love that customers have, that gives you a sense, okay, this company might be onto something special. And so a lot of the process we go through with founders is figuring out how to package up that, call it special sauce, the kind of what Jenny alluded to about all the different pieces that make this company unique. But I think when you really boil it down, it all looks ultimately like, does this company have truly irrefutable product market fit? I tend to think of the seed stage as almost an experiment. You're testing out hypothesis that people will love something and pay for something. And by the time you're getting to a Series A, it should start to feel like, oh, there is a real company there. And that ultimately is the basis in many ways of raising a Series A. The deck, if you're taking the first 2 or 3 slides, ultimately looks like, here's the problem. We're the world's leading X and people love us and it's working. And those are your first kind of initial, here's what we have.
Right. And
yep.
It's kind of at that
or even
point,
if it's not ready to scale, it's at least there is something about this that people love.
Yeah.
And now it's building, ideally scale or some other variant of it, but it's like, it's working in some way, shape, or form.
Yeah, Alexandra, I'd love to get your thoughts on this just from your experience, and you've kind of been out there and raised multiple rounds for multiple companies. Have you ever had that challenge, or is it just that you feel like when you know, like from a founder's perspective, how have you seen kind of the process of thinking about when and how to raise follow-on capital?
Well, my first startup was working with Kevin Ryan on Guilt, and that was incredibly helpful because he had been through the fundraising process a number of times before. So I learned a lot from him and kind of watching him balance the art of the fundraise. When I was at Glam Squad, it was my first time in a CEO role. So definitely had, was together with my co-founders, but had a lot more responsibility in terms of fundraising. And I think, something I saw both in Guilt and Glam Squad and a lot of the businesses that I've worked on, either as a founder or as an advisor or an angel, a lot of them do cater to female consumers, and they certainly have a male consumer base too. But in some cases, I feel like investors are going to respond best to an investment if they really understand it, especially I'm talking about consumer investments. So in some cases, when I was building and fundraising for businesses that were really targeting a very specific, more female mindset, the reality is there were certainly a number of male investors who didn't quite understand the pain points that we were trying to solve. So that I think was a reality, and it's not to play a woman card because I don't like doing that. But it's just that, some of the businesses that we were raising, I think were just less tangible for some male investors to really understand firsthand what those pain points we were trying to solve for.
Yeah, that's a really interesting point. And maybe Jenny, you could help us think about this too, because I think you probably, deal with such a wide array of later stage investors for the portfolios you work with. When you think about matching and identifying like who is the right investor, who is the right partner, how do I target? I think your point isn't really just about female investors, which obviously was specifically the case for Glam Squad and similar companies, but just in general, finding that kinship with the category. Is I believe what you're saying, Alexandra. And so Jenny, how do you think about that? Have you advised companies not to take money from a certain investor, but rather, or to, specifically consider a particular investor because of the strategic benefit or the fit, or even just the category alignment? Like, how do you think about that navigation in terms of making the right decision? Because it is, having been a founder myself, is such an important component of building a business, just putting the right team of investors around you.
Yeah, I think oftentimes, especially at the early stage, founders just want to get back to work. And so if cash is coming their way or they've got options, maybe they'll take the highest valuation or they'll be inclined to. And I think what we try to coach founders is exactly what you said. This is a long game, and you need these people to be on your side, not be short-term thinkers. You really want people that are incentivized to help you for the long term. And so, those are all things that we help founders kind of navigate. But yeah, I mean, it's part of my job to really get to know, you know, them as much as possible. At Techstars, we like to bring them into the process. We have many, many folks that are mentors that are, you know, primarily investors, but they come in, they kind of take off their investor hat for a few hours during the program and really get to know founders. Many of them are previous founders themselves, right? And so it really is this idea of kind of giving back, getting to know founders. And I think that, you know, that can really resonate. We tend to push founders, you know, in their direction as a result of it, right? So, you know, investors come in many flavors, and we just encourage the founders to get to know them as much as they can, even as these rounds are coming together quickly, and don't just think about valuation or, you know, reputation. Really, like, do I have a connection with this person because they're going to potentially be helping me or not helping me for the next 10 years.
Great. With that being said, we've kind of got through 30 minutes. So what I would love to do at this point is maybe introduce a couple of questions. I believe we are going to try an experiment and invite a live question from Genevieve. And so I think if we can invite her into the conversation, would be great to have her join. I think here we are, Genevieve. Hi. Oh, I think you're muted. Hold on a second. There we go. Go ahead.
Can you all hear me?
Yes.
Hi guys. Hello, Jenny and Alexandra. Good to see you all. Nice to meet the rest of you. Thanks for doing this. I'm Genevieve. I'm the founder of Real World. We help young adults navigate life moments starting with graduation. So busy time of year for us at the moment. But I was hoping you guys could double down a little bit on what you were talking about with metrics. So I think something that I heard from the beginning when I was starting the company was, as a first-time founder, you can either raise off of narrative or you can kind of raise off of metrics. And sort of, you know, now that we actually have a product in market and it's doing relatively well and we're tracking those metrics, I thought you could talk about, you know, one, how to blend the narrative of what we've been building with those metrics, both now in the post-COVID world, also kind of looking ahead to that more profitability oriented mindset. So not just focused, as Alexander said, on top level growth, really how we're building a company that's sustainable, that's long-term, addressing a problem. So any thoughts you have to share there would be appreciated.
I will leave the floor open.
I'm already an investor, so I'm going to leave it to Brad, Alexander, and Karl. So I'm already a super fan.
Yeah, there you. I guess, I mean, the one thing I'll sort of react to is like, I think you're absolutely right. There's sort of narrative and metrics, but I think in a way that's a little bit of a false dichotomy, because ultimately, what are the two together? The narrative is, why can this be a truly legendary and important company? Or why does this solve a need today, but why will it be truly legendary down the road? And the metrics are, we are on that path to get there. And so in some ways, the best founders are able to dovetail those two together in a way that are, every startup is a baby step along the way. And it's, oh, the metrics are showing you these baby steps are working and we're moving forward quickly and it looks really terrific. But the destination looks ultimately interesting and can be that publicly traded kind of company. That's at least the frame that I would look at it from.
Yeah, I might just add that I think that there's a bit of a balance because it really depends on where you are. I think when you're very early, the narrative takes the majority of the conversation and you're really selling people on your vision. But as you become more and more mature as a business, the metrics become more and more important. And it's the proof that that narrative is actually, as Brad said, you're on the journey for that narrative that validates maybe the later stages of investment. Alexandra, did you have any thoughts?
Yeah, I was just going to add, I agree with what both Brad and Karl said. I think that, and I said it earlier, engagement really matters. And I think the smarter you are in understanding how are your users using your product, why are they using it, you know, is it going viral? Are they telling their friends? Are you finding new consumers that are of a similar cohort or demographic? Are you able to find them, find pockets of them? And I know a lot about your business, so I know how you find some, but are you marketing to them in the right channels? So if you're targeting Gen Z, are you on TikTok? If you are trying to target young consumers graduating college and ending up in urban environments? How are you doing that? How are you finding these clusters of consumers and understanding who are the types, the psychographics and the demographics of your consumers, who are your most power user, loyal real world consumers, and learn from that?
Great. Thank you, Genevieve. I appreciate it.
The only other thing I was just going to just mention was more generally, because I agree with Alexander around engagement. And I think that's true for consumer, but I would actually say for every founder out there, that's broadly true. It's ironic, even for the most dull SaaS business, customers will buy it and love it because it solves a real need. And that love, that engagement ultimately ends up being something every investor really views as valuable.
Great. Thank you, Brad. Thank you, Genevieve. I think we may have time for one more question if I squeeze it in. Not a live one this time, but I will read it. And I think this question is interesting because it actually speaks to something that is a persistent issue, not a momentary issue. From Wayne Holder, can a startup company that has very limited cash, but with a great concept, product that still needs to be created, raise money? I ask as I am concerned that many young entrepreneurs enter the market with huge student loan debt and cannot raise finance on their own. Are we going to see a decline in entrepreneurship as a result of this? Love thoughts on that. I think Jenny, and maybe even from where you are with Techstars, would have a really interesting perspective on that.
Well, interestingly, I wrote a blog post recently about our application breakdown for Techstars New York, and we've never seen so many applicants that are graduating undergrad. So we always see a lot of MBAs coming out and starting companies, but the number of undergrads that are starting seems to be going up. So I think this is a real interesting moment in time where, students and young people are really feeling empowered, and, it's a great time when you're younger, your risk appetite is higher to, go start a startup. Definitely student loan is, are an issue, and something to be wary of, but the numbers are showing that more and more young people are starting businesses.
Yeah, I would concur with one very clear statement, which is the best time to take risk is in the very beginning of your career, because I think you have plenty of opportunity to, fail, learn, succeed, grow through that and kind of find success over time. And the later you get in your career, the harder it is. Once you've actually got, more to lose, it's much harder to take that step away and say, I'm going to take the risk at this stage. So I would really concur with that.
I would just say, the only thing I would say from our perspective also, because it's certainly from, as you say, student debt is really difficult, but I've also observed that in this world, makers have the just drive to make something. And so regardless of what that looks like or where it fits in after work or things like that, that's something we as investors value a lot. Someone who just needs to scratch that itch, even if it's just duct tape and baling wire in the beginning, but just something to demonstrate that they're a true maker creator.
And I would say, looking at some of the, if we do talk about incubators as a methodology for people to find their way into entrepreneurship, if I look at the classes that I've met coming out of Techstars and other incubators, I think that there is a real appetite for really smart graduates that are looking to build their first businesses. I've seen a bunch of that and found some really, really interesting opportunities, and have invested actually in one or two very specifically that are, young graduates that are just doing fantastic things, itching that itch that Brad is talking about. So I would definitely always encourage young minds to kind of put their creative juices to work. So with that said, I think we're running out of time. So I really want to thank everyone, Brad, Jenny, Alexandra. That was a really, really enlightening discussion. I think we had a really good short journey through, the experience from just first starting a business through to the point of what it takes to think about each of the investment stages. And really appreciate all the attendance and the questions. And with that being said, thank you all, and we will see you all soon.